Hi, uh, it's nice to see you all. And today we are going to look into the journal entries, how to prepare the journal entries, how to pass the journal entries. So, journalizing techniques. First of all, journal entries in the sense uh, debit and credits, right? How to pass the debit and credits, right? First of all, we will try to learn how to pass pass the journal entries in our book of accounts, right? Before passing journal entries, you have to identify how you have to go through few steps, right? First, that is called journalizing techniques. First, analyze the transaction. Okay, first analyze the transaction, read and understand the transaction. Then second, identify at least two accounts involved. Identify at least two accounts involved. That is debit and credit. Okay, debit. One is debit and other thing is credit. Find in which category each of them fall in. Find in which category each of the accounts fall in. That means if you say I already in previous chapter, that's what I taught you. What is the asset? What are the divisions of the assets? What is the equity? How it is made up? And what is the revenue? What is the expenses? And what is the liability? How the liability is categorized and things so on and so forth. So now it will be easy for you to understand how to pass the journal entries. Journalizing techniques. Number one, analyze the transaction. We have seen identify at least two accounts involved. That also we have seen. Third one is find in which category each of them fall in. Whether it is falling into the asset account or liability account, or whether it is falling into the equity account, or whether it is falling into the revenue account, or whether it is falling into the expenses account. Okay, so that is third step. Fourth step is see increase and decrease, whether it is increasing, whether it has an effect of increase or decrease in such accounts. That if the asset is increasing, you have to debit it. If the asset is decreasing, you have to credit it. Like that, in the equity, when the equity is increasing, you have to credit it. When the equity is decreasing, you have to debit it. For the revenue, always revenue is a credit balance. It is credited. Increase in revenue is credited, decrease in revenue is debited. Expenses, increase in expenses, debited. Decrease in expenses, credit. Likewise, liability. Increase in liability is credited, decrease in liability is debited. So that is what we want to see, the increase and decrease, whether it has an increase or decrease in such accounts, right? Use the rules, debit and credit, use the rules. Okay, now before that, before you going for the exercises, right, just you go through the what you call format, where I have given modern equation, right? In that I have told you I had taught you asset, liability, revenue, and this thing, and whether it is increase or decrease. If it is an increase, if it is a decrease, what is the entry has to be passed, right? But anyway, I will again show you that format, okay, to refresh you all. Then if you have that format, it will be I cannot expect that I cannot believe that whether you will see or not in previous chapter. So I will give that format now, and we'll try to solve this problem, right? Which problem? Here one problem is given for you to solve, right? So there is a 10 questions are there. So for that 10 adjustments were there. So is there, you have to work it out, right? Now we will see the rules, what you meant by the rules. That is already we have seen, but anyway I will give you here, right? Degrees, here I will say, wait, for a minute. Here I will say right, you say increase, increase in sorry, degrees, right? Degrees, degrees, okay. Here we will say increase, increase, okay, increase and decrease. Yeah, description, okay. Say here, here increase. Again I am making mistake. See, R A S C, increase, okay. So this has to be closed, okay. Okay, here we will say description. Description, right? So now we'll start passing, recording the this thing. Here first we will see asset, right? Asset, right? If it is increasing, if the asset, is increasing, you have to say, you have to put debit, right? If the asset is decreasing, you have to credit, you have to pass an entry of credit. Next one is liability. If the liability is increasing, you have to pass a credit entry, okay. If the liability is decreasing, you have to pass a debit entry, okay. Next one, equity. Equity, if there is any increase in the equity, you have to credit it. When there is a decrease in the equity, you have to debit it. Okay, understood? Then thereafter you have to say debit. What you call revenue. If there is an increase in revenue, you have to credit it. If there is any decrease in revenue, you have to debit it. Okay, and other thing is expenses. If there is any increase in expenses, you have to debit it. If there is any decrease in expenses, you have to credit. This is the rule. Understood? This is the rule. Yes, it's the rule. You have to keep it in your mind. Understood? When the asset is increasing, debit. When it is decreasing, credit. Because asset is coming in, then you are debiting. When the asset is going out, that is decreasing, credit. Liability, when the liability is, we are settling the liability, means our liability is decreasing. Our liability is decreasing in the sense we are going to debit it. When the we are our liability is increasing, we have to credit it. Equity also same like liability. If the liability equity is going increasing, we have to debit it. When the equity is decreasing, we have to debit it, and increasing is credited. Revenue, if the revenue is increasing, we have to credit it. If the revenue is decreasing, we have to debit it. When the expenses is increasing, we have to debit it. When the expenses are decreasing, we have to credit it. If you remember this rule, the rest of the thing is easy for you. Okay, now we will see how to solve this problem. Okay, exercise. Okay, so first in this problem, solve this problem in the sense exercise. One is Dravid started the business with cash 500. Number one, what is the journal entry? Number one, journal entry. Dravid started business with cash. What are the accounts affected? First, analyze the transaction. Dravid started the business with cash. 500,000 cash coming in, and capital is going there. So identify at least two accounts. One is cash. You are identifying two accounts. That means cash. One is cash. Other account is capital. Okay, capital and cash. Cash is coming in 500,000. So you are debiting. Cash is debiting 500,000 Okay. Capital account is crediting. You are crediting capital account 500,000. Okay. Cash account debited 500,000. Capital account credited 500,000. Here, when you are passing the journal entry, you have to write the narration. You have to put here narration being cash brought in by owner. Okay, being cash brought in by owner. That is the narration. Okay. Number two, second adjustment, he paid into bank 70,000. Number two, adjustment number two, paid in to bank. Bank, what are the bank? He's paying 700,000, 70,000 to bank. 70,000 going out. So bank account is coming in. So bank account, one is bank account is affected, other one is cash account is affected. Cash account. What are the two? He paid into bank 70,000. What is the, this is we have done, right? Okay, now we are doing this, right? He paid into bank 70,000. Bank account debit, okay, cash account credit. How much? 70,000. Right? Because cash is going out, bank is, for the bank, cash is going out. Cash from the cash point is going out. For the bank point, cash is coming into the bank. So into the bank debit, cash going out, it is credit. Okay, narration being cash deposit to bank. Right? Being cash deposited to bank. Okay, understood? And third adjustment, we are going to do the third adjustment, that is bought goods for cash 50,000. We have purchased goods for 50,000. So what are the accounts affected? One is we have bought goods for, one is purchases. Purchases, and other account is cash. Two accounts affected. One is purchases and other one is cash account. Purchase account debit, cash account credit. Okay. Bought cash for 50,000. Purchase account 50,000 debit, cash account credit 50,000. Okay, that is the W94 adjustment number 3, bought goods for cash. Okay, purchases account coming in means goods are coming in, cash is going out. So if it is going out, you have to credit it. If it is coming in, you have to debit it, right? And there is a increase in purchases. Purchases is expenses. Then debit it. Cash decreasing. Then asset, cash coming under the asset, decreasing, credit. Okay. Earlier also we would have explained. I should have explained like that. Okay. For this being purchase made for cash, being made for cash. This adjustment is being purchases made for cash. Okay. First of all, I will do the same explanation. Dravid, I will give more explanation. Dravid started the business with 500,000. Means cash is coming in, means cash is increasing. That means asset is increasing. Then if it is increasing, debit. Capital is the equity account. Equity is increasing. If the equity is increasing, it has been credited. You see, credit. Here, second adjustment, he paid into bank 70,000. Cash is decreasing. If you are paying, cash is decreasing. Cash is going on, cash is decreasing. Means asset is decreasing. If the asset is decreasing, cash account is the credit balance, right? Where you pay the cash to the bank account. Bank account is a asset account. Asset account increasing again. Say asset is increasing. So both are happening within the assets account. That also current assets account. So the effect is nil. Net effect is nil. Okay. And third is bought goods for cash. Third, he purchases goods for 50,000 cash. There's an increase in purchases means expenses debit, purchases debit, decrease in the cash because we are purchasing, cash is going out, then cash is decreasing. If the cash is decreasing, cash belongs to the assets also decreasing. If the assets is decreasing, it has to be credit. It has to be credit. Okay. Third adjustment also okay. Now we will say fourth adjustment, sold goods for cash at 60,000. Sold goods for cash for 50,000. Means what are the two accounts affected? We have sold goods for cash. One is sales account. Other thing is cash account. One is sales account. Other thing is cash account. Sales account, cash account is debited. Cash account debited. One is cash account is involved. Other is sales. Sales account involved. How much? 60,000. Okay. Cash account debited. And sales account credited. Okay. Here what is happening, we are making the sales for cash. Cash is coming in, cash, then cash is increasing. If the cash is increasing, asset is increasing. If the asset is increasing, debited, cash is debited. Sales is the revenue is increasing. Okay, if the revenue is increasing, it is credit entry. Here it is satisfying the both rules. Then the narration is being sales made on cash. Okay, that is the entry. And number 5, adjustment number 5, right? 4 is finished and bought goods from X for 55,000. It is a credit purchases. Bought goods from X. We are buying goods from X. What are the accounts affected? Purchases account is affected, goods accounts and purchase account same, those are affected, and other accounts is trade creditors, X account, right? You'll say purchases account, purchase account debited, and trade creditors that is X is credited. How much? 55,000. Here is 55,000. Here is 55,000. Okay. For this, what is the narration is both goes from being adjustment for credit purchases. Being adjustment for credit purchases. Understood? Here purchases, we are making the purchase account debit and trade creditors X account credit. Because creditors are increasing. If the creditors are increasing means liability is increasing means credit. Purchases is an asset. It is increasing. Purchase are made. Purchases increasing coming in. Purchase account is debited. Okay. And number 6. So that is finished. Okay. Okay. Understood? Purchase 6. Number 6. Adjustment number 6 is sold goods to Y. Sold goods to Y. We are selling the goods on credit. Then credit, we are selling the goods for the credit in the sense that is the debtors. We are selling on goods on credit. So it is debtors. Trade debtors debit and sales credit. Trade debit and sales account credit. What is the amount? 30,000. Okay. Being adjustment, being adjustment made for credit sales. Number 7, here I didn't give explanation. The trade debtors, because we have made a credit sales, so sales is increasing. We have made a credit sales, then sales is increasing, means revenue is increasing, then it has to be credited, sales account credited. And debtors are degree, debtors also increasing. Debtors belongs to assets increasing means debitor, asset increasing means debitor. So that is the thing. Number 7 is received from Z, rupees 3,000. Received from Z. No, sorry. Received from, received from Y is 30,000. Cash received from Y is 30,000. We are receiving cash from Y. Y, who is the Y? Y is the person trade debtors. Cash account debit, trade debtors account credit. Okay. Cash account debit, trade debtors, that means Y is credited. Okay. How much? 30,000. Being cash settled by the debtors. Okay. Because debtors are settling the cash. Then when they are paying the cash, cash is coming in. Mean cash is increasing. Cash is increasing means asset is increasing. Then cash account debited. Trade debtors are settling. Then that is trade debtors amount is decreasing. Okay. Trade debtors, if the trade debtors are decreasing, trade debtors account should be debited. Trade debtors should be debited. Sorry, trade debtors should be credited. Okay, because decreasing, trade debtors amount is decreasing means it has to be credited. Now we will see the eighth adjustment. Okay, eighth adjustment. Adjustment number rate. Adjustment number 8. Right. Adjustment number 8 says paid to X 55,000. X, who is that X? X is the trade creditor. Then trade creditors account debit, account debit 30,000. Okay, cash account credit 30,000. Credit 30,000 being settlement of debt. Okay, because in adjustment number 8 is we are paying to our creditors 55,000, sorry, 55,000, 55,000. Okay, okay, we are paying off our creditors. We are paying in the sense our cash account is decreasing, right? Cash account we are paying, cash is going on, then cash is increasing. If the cash is increasing in the sense debtors in assets is increasing. If the assets is increasing in the sense cash account should be debited, right? Trade creditors, we are settling the trade creditors, means there's a decrease in the trade creditors. If there is a decrease in the trade creditors, it should be debited. It is debited 55, right? Number 9, purchased building for 700,000. Purchased building for 700,000. What are the accounts affected? One is building account, other thing is cash account. Okay, building account debit, account debit 700,000, and cash account credit 700,000 being purchase of building. Okay, so number 10 is, here two accounts is affected because we are purchasing a building, means buildings are increasing. Buildings are increasing in the sense assets are increasing. Assets are increasing in the sense we have to debit the asset account, building account. We have debited. To buy that building, we are paying off the cash. If we are paying off the cash, means cash is decreasing, then assets also decreasing, then it has to be credited. Cash account credited. Okay. Number 10 is sold furniture for 30,000. Sold, we have sold furniture for 30,000. So we assume it has been sold. It was sold for cash. Okay. Then cash account debit, furniture account is credited. But what are the accounts affected? Cash account and furniture account. Cash account debited, on and furniture account. Cash account debited, furniture account credited by 30,000. Right? Being disposal of furniture. This is a disposal of furniture because when we are selling our furniture, it's the extraordinary activity. Cash account debit, furniture account credit. Okay, cash account debited, furniture account credited because cash is coming up in, furniture is going out. Cash is coming in the sense assets are increasing. Cash is increasing, assets are increasing. Furniture is going out in the sense furniture account is decreasing and assets also decreasing. So furniture account is credited and cash account debited. So when you are prepared, when you are answering these things, if you questions, if you keep it in mind, this, if you consider this chart, it will be easy for you to answer my questions. Okay, I think you would have understood, and we will move on to next lesson.